Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, President Trump set to meet with Vladimir Putin today. We'll discuss the potential outcomes from that event and what it could mean for financial markets. Plus, Chile sees red-hot sales. We'll sit down with the CEO of its parent company to see whether the momentum can continue. And Opendoor CEO Carrie Wheeler is stepping down as the meme stock actively searches for a replacement. Let's get a check on the broader markets first to kick off the Friday session here and to cap off the week. We are seeing a little bit of wavering here. Remember, the S&P 500 once again closed at a record yesterday. It's pulling back from that level today, down about 0.25%. The Dow, the lone gainer of the three major averages, as we talked about earlier, helped by United Health, and the Nasdaq lagging today, off by 0.4%. Looking at the bond market, we have been seeing yields kind of bounce around on the back of economic data this week. Today, with retail sales coming in pretty broadly in line with estimates and showing relatively broad strength, we are seeing no change in the 10-year yield. It's at 4.29%. Big gap, though, as we see between the 30-year and the rest of the yield curve. President Trump and Russian President Vladimir Putin are set to meet in Alaska today to discuss ending the war in Ukraine. President Trump has threatened what he says are severe consequences against Russia if Putin does not agree to move forward with peace talks. Joining me now, General Wesley Clark, Wesley K. Clark and Associates Chairman and CEO, and Ed Mills, Raymond James Managing Director. Gentlemen, thank you so much for being here. And of course, General Clark also was Supreme Commander of NATO during the Kosovo War, so definitely has some experience in the European theater, so to speak. General Clark, what are you watching today? What does sort of success look like, and what should we be looking for out of this meeting between the two leaders?
Well, I think President Trump's done a really good job of lowering expectations. So he wins if there's an agreement for a second meeting, and if he doesn't look like he's subservient to Vladimir Putin. So he's going to play this as best he can. There will be trouble if it gets into territorial concessions and things like this, and I think he's not going to let it go in that direction. So I think what we're going to look for is, can he keep the focus on Ukraine, or will President Putin try to draw him into a broader discussion of U.S.-Russian bilateral relationships, which would be, of course, executed at the expense of our European partners and Ukraine?
Well, to your point, there is this sort of wild card of how successful Putin will be in those aims. As we know, he's pretty good at influence in person, right, historically. And so what does President Trump sort of need to be careful of in terms of being drawn in by Putin?
So I think he's got to be very careful not to be overly exuberant about the possibility of U.S.-Russian relations. After all, Russia is an aggressor state. It's broken all the rules of international conduct that we enforced since World War II. And Putin hasn't relented on his aim to take all of Ukraine and go back into the Baltics. So we've got to be very careful not to think that some promise of a strategic arms agreement between the United States and Russia could make up for a split between the United States and its European allies on this critical issue of Ukraine.
Ed, I want to bring you into this as well because, your audience is investors and our audience is investors. And I'm curious from an investment perspective what people really need to pay attention to here. As we know, a broad swath of assets has sort of been affected by Russia's invasion of Ukraine. So what could move the needle in terms of these talks today?
Yeah, Julie, so at Raymond James, what we've been focused on is if we get a statement coming out of this meeting that's big and bold, are we going to see a pretty big market move? And we've seen in times past when President Trump has been on the international stage that he loves that big, bold announcement saying that this could be even greater than we expected. The reality is that those details usually are not fleshed out at these meetings and that we get disappointment later on as it drags out. Where I've gotten the most questions at Raymond James is what's the impact on energy markets? If there is a ceasefire, are we going to see some of the rally that we've seen in certain energy sectors come back in? Are we going to see a continuation of rallies in Europe? If there is a view that this could be a lasting peace, that is a benefit to European economies. We also are questioning what is the longer term defense budget here in the country. Defense stocks absolutely being affected by this, Julie. I do think that regardless of what happens here, we are going to see a very robust defense budget here in the United States, and even greater budgets going into the future. So it could be a temporary change in some sentiment, but I don't think it changes the long-term trajectory of a lot of those investments.
And for viewers, we're actually going to be digging more into the defense stock space specifically on Monday with a portfolio manager who concentrates on that area. General Clark, obviously there is the Russia-China or Russia-U.S. talks, but then there are implications, I was going to say, for China and other sort of partners that we are still in negotiations with. And I wanted to ask about India in particular. If the talks don't go well, Treasury Secretary Besant has said we could see secondary tariffs on India, for example, go even higher as they purchase that Russian oil. What does that do to the sort of axis of power? And is there a risk that pushes India even closer to China, for example?
There is certainly that risk. And already, I think the administration has made a strategic mistake by the sanctioning of India and not China on the announcement of these secondary sanctions. You know, for 25 years, we've worked to try to bring India in from the cold. India was aligned with Russia during the Cold War, or with the Soviet Union. And every American president sees this India is the largest democracy in the world. Wouldn't it be wonderful if we could bring it on our side and have it work with us? And we've tried to do that, but it seems that this administration is taking it the other way. So I think that's a real risk in where we are right now.
I'm also curious, General Clark, in terms of optics, which are always important from these types of meetings, is there a risk if President Trump backs down or gives concessions? Are there implications then in trade negotiations in terms of his stature and how he looks in this negotiation?
Yes, everything's connected to everything else. And it's not only the trade negotiations, but I hate to bring this in, but President Trump is a master of domestic politics intertwined with international politics. So, 3 weeks ago, everything was about Epstein. Now we've had what's happened in D.C. We have this that's dominating the news cycle globally and the United States. So I think he's very much aware of his objective in terms of domination of the news cycle. I think he's going to be very careful as he moves forward to take the minimum he can get out of this, to look strong, to look like he's moving on a good trajectory. I hope he won't be seduced by these broad proclamations of everything's going to change with Russia right now, because it won't. But he's got to resist that temptation and move us forward step by step. We all want the war to end in Ukraine, but it has to end in a way that strengthens our relationship with Europe and contains the seeds of strengthened American credibility worldwide. And that includes the credibility of President Trump in dealing with these tariff issues.
And speaking of that, Ed, is this Putin-Trump meeting a precursor to an eventual Xi-Trump meeting as well, and sort of more progress and even a completion of the negotiations over tariffs with China?
Yeah, so our base case is that President Trump and Xi will meet on the sidelines of the APEC summit, probably before the summit in November. What my sources have been telling me is that President Trump has told his administration, do not put up any barriers to that meeting happening. One of the key drivers of the desire to have that meeting is that we need the critical minerals and rare earth minerals that China has been restricting. If we don't have that, we don't have the industrial capacity to make a lot of what we make in this country. So near term, our expectation is that the U.S.-China relationship is going to be pretty decent, at least until that November meeting. So we have this ongoing pause on tariffs. We're going to see more shipments of chips into China. I don't think that we're ever going to see those secondary sanctions that have been put on India get put on China in that near term. So from a market perspective, that's a pretty positive sign. I would have thought I would be here after that August 12th deadline, talking about a re-ramping of tensions with China. So from a market perspective, this has been a huge relief and part of the rally that we have seen. As we have seen tariffs go up on other countries, tariffs have been delayed with China.
Right. That's a really interesting point, Ed. And Ed, also, as General Clark just said, everything's connected, right? So do you see any implications from these Russia-U.S. talks for the China-U.S. negotiations?
Absolutely. China will be looking at this very closely. I think what's interesting about President Trump is that he thinks that he is always able to go into the room and cut the deal. When I've talked to my sources about President Xi, he's not someone who likes to go into these negotiations with a lot of live balls. He likes to be at 99, 98 maybe percent things set up. If things don't go his way, he shuts down, he lashes out, is what I'm told. And so we do have a personality mismatch, but they're going to be watching what can Vladimir Putin do to get President Trump closer to his side. Is that a playbook for the Chinese government to get more concessions out of the United States, especially since they saw how much concessions they've been able to get out of us because they restricted such an important amount of rare earth metals that we couldn't make a magnet, that we weren't going to be able to make planes here in this country. Looking at those pressure points, seeing President Trump respond, those are really good indicators of what they will try in the future to see what they can get out of this administration.
Gentlemen, thank you so much. Great perspective on what is a high-stakes meeting, in the words of President Trump. Thank you very much.
Thank you.
We got much more markets action coming up, including a conversation with the CEO of Brinker, parent company of Chili's.
Welcome back to Yahoo Finance. I'm Ali Canal, live at the NASDAQ, and let's get a quick check on the market action about 1 hour into the trading day. And we're seeing the major indexes waffle a bit after consumer sentiment declined on inflation expectations. This was the first downtick in 4 months. You're seeing the S&P and the NASDAQ trade in the red there. The Dow is still trading in the green, just up about 50 basis points, and this comes on the heels of United Healthcare, which I'll get into in just a bit. But I also want to take a look at the 30-year yield, because that is now 109 basis points higher than the 5-year, otherwise 1.1% roughly. Now, this is the widest gap since 2021, and it comes on the heels of greater expectations of Fed rate cuts. Markets are pricing with near 100% certainty that the Fed will cut interest rates in September. And then looking out over the rest of this year, markets continue to price in between 2 to 3 rate cuts, with more cuts expected in 2026. So important to keep an eye on what's happening in the bond market. And then I want to look at some individual movers. I mentioned United Healthcare. That stock is up a whopping 11% today after Berkshire Hathaway, this is Warren Buffett's company, it took a $1.6 billion position, purchasing 5 million shares. You're seeing that boost today. I also want to check on Intel shares. Those are seeing a nice pop this morning, up around 4% on a report that the Trump administration is eyeing a stake in the company. This has yet to be confirmed. Intel saying in a statement to Yahoo Finance that they're looking forward to working with the administration, but did not go so far as to confirm that report. We know that for Trump officials, this is a matter of national security. They really want to bring a lot of that chip production back home. They do have that agreement with AMD and NVIDIA to have a revenue sharing deal where they are allowed to sell chips to China as long as they kick back some of that revenue to the U.S. government. So all really unprecedented moves, really unique situation in today's environment. So we'll continue to track all of this, but keep it right here on Yahoo Finance. We'll be right back.
Now time for some of today's trending tickers. We are watching Opendoor, Intel, and Roblox. First up, Opendoor. Those shares are jumping as the company's CEO steps down effective immediately. The board has appointed an interim leader, but it's actively searching for a new CEO. Earlier this year, hedge fund manager Eric Jackson made a series of posts online about his bull case for the stock. That led to an influx of buying from retail investors, which sparked a meme stock rally. Opendoor is known for its software-driven approach to flipping homes. The shares are up 7% today. They have been very volatile as they've gotten memey. Next up is Intel. It's getting a boost after the Trump administration, a report the Trump administration is considering using CHIPS Act funding for its reported stake in the company. Bloomberg News previously reported that the White House was weighing a stake in the chip maker. Just the other week, President Trump called for the CEO to resign. Now the government reportedly in early talks for a stake in the business. Intel was already poised to be the biggest recipient of CHIPS Act funds. Under the program, the company was awarded nearly $8 billion in grants for commercial chip manufacturing. The White House did not respond to Bloomberg's request for a comment. And finally, Roblox shares are singing today as Louisiana's Attorney General sues the company. The AG alleges that it facilitates the distribution of child sexual abuse material. It also said the company fails to provide notice to parents and child users of its dangers. TD Cowen did affirm a sell rating on the stock and wrote the regulatory risk is non-negligible at the company. The analyst noting the Roblox has a massive user base that heavily skews young. He says the business model depends on user-generated content, and that is the area creating the most risk for child safety issues. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, I'll be joined by the CEO of Chili's parent company, Brinker International. We'll discuss the company's turnaround, the health of the consumer, and more. That's next on Market Catalysts.
Well, American workers are increasingly invested in stocks. We know that in their retirement funds. Vanguard Group found workers in their late 30s had 88% of their 401ks in stocks last year. That's versus 82% a decade earlier. And a new sentiment survey from Investopedia shows retail traders, they're more interested in individual names than ETFs, with the data showing if folks had 10,000, 22% of respondents would put that money into individual names. Caleb Silver, Investopedia editor-in-chief, he's with me now. Caleb, let's start. I want to know how Investopedia fans, how are they feeling? What's the vibe there?
The vibes are strong. The vibes are immaculate. Record highs will do that to you, right? And we've had a lot of them lately, and they see this deregulatory environment. They see the fact that rates are coming down, and they've seen some outperformance, not just in their favorite stocks, which look a lot like the top of the S&P 500, but in a lot of smaller stocks as well. So they've been paid for their patience, they've been paid for hanging in there, and they've been more aggressive by and large than a lot of institutional investors. P.S. Institutional investors, according to Bank of America's most recent fund manager survey, also as optimistic as they've been in 6 months. But again, higher highs will make you feel pretty good.
So good vibes. What are they doing with those vibes? What are the names they want to own?
Yeah, they own their home cooking. They own the stocks that they've owned ever since they probably got in this game, and that is the top of the S&P 500. NVIDIA tops that list. Palantir, new but rising onto that list. Microsoft, Apple, Amazon, of course. You see some Berkshire Hathaway in there. You see a little Costco sprinkled in there and some banks like JP Morgan. But by and large, mega cap tech, anything AI related of size, they stick with them. They've been paid well and handsomely for sticking with their bets.
Now, another question you ask, which I always think is interesting, you also ask, hey, what do you want to own 10 years from now? What was their answer?
Yeah, well, a lot of the same stocks. NVIDIA is on the top of that list as well. Palantir, one of the top stocks on that list as well. Microsoft, I see there as well. Even Alphabet. So not a lot of change, because why change when we are really in the land of the giants? The big stocks move the market. We were talking with a guest earlier that says they are the market. If you're not in these big stocks, you're not just moving, you're not having that outperformance. So they have to be in them, and they've been rewarded, again, for holding these stocks. You don't see a lot of them exploring a lot into other sectors beyond big tech right now and beyond smaller stocks, but you do see them globbing onto the same things that have delivered the performance that look like the QQQs, that look like the SPYs. That's where they stuck their money. That's where they intend to stick their money. And as the market has been rising for the past couple months, that's where they put even more of their money. And
you also asked them, I like this part of the story, you asked them, listen, if you had an extra 10 large, an extra 10,000, where would you put it to work? Where would you commit capital? What was their answer?
Yeah, this is the ultimate discretionary question. What would you do with an extra 10,000, assuming you could invest it and individual stocks top that list? And when you have this rising bull market and records after records coming in day after day, that's what you get. They want to own the individual names because that's where their performance has been. Second on that list is ETFs. They want some diversification there. That makes a lot of sense as well, but basically keep buying the same stocks that have delivered the returns and that have made them 401k millionaires. And when you look at survey after survey, we have more than ever right now. As you mentioned, Vanguard saying more and more people contributing stocks to their 401k plans. We are a stock-heavy nation.
If you ask them some of these questions, let's say 6 months ago or 12 months ago, has there been a big difference? I mean, has it evolved a lot?
Absolutely. And they went from trying to be safe with CDs and high yield savings to back to stocks, back to ETFs. So you see that seesaw depending on behavior and depending on how the market's doing right now. When we had the big sell-off, everyone was running for cover. There was gold was topping that list as well. But they were looking for places to be safe. ETFs were a little bit stronger than individual stocks because of the diversification. They'd seen some big tumbles in some of their favorite stocks. But when you get a bull market like this, when you get records after records, people want to own individual stocks. Again, biggest stocks in the market just keep getting bigger.
And when we talk about the folks you're surveying here, remind me, Caleb, the Investopedia fan, who is that fan? What's the demo?
Yeah, the Investopedia reader is right here, you and me, right? 18 to 80, self-directed, educated investors who like to invest their own money. Maybe they also get professional advice to do it as well, but they're interested in learning how this works, and they come to us to get smarter about it. But we're talking about adults, average age in their 40s or so, but we do have this big range of people who are just starting to learn to people who are kind of nearing the end of their investing journey but still want to stay smart. So this is kind of everybody, and it's a pretty good representation when you think about the size of our reader base.
Chili's is outpacing its competitors with red hot sales, get it? Driven by heavy marketing and menu changes. Its parent company, Brinker International, reporting a 24% jump in comparable sales at the chain in its fourth quarter. Meanwhile, we saw spending at restaurants and bars broadly decline 0.4% month over month in the latest retail sales data, mirroring what other consumer-facing companies have warned about slowing consumer spending. So can Chili's maintain its momentum with that tougher macroeconomic backdrop? Joining me now is Kevin Hochman, Brinker International CEO. Kevin, thanks so much for joining us.
Hey, thanks for having us on, Julie.
So as I mentioned, Chili's, you guys have been on this turnaround journey that has seen these double-digit comparable sales gains sort of quarter after quarter after quarter. What is your visibility now into the second half of the year, given that we have seen some more sort of wavering consumer spending? For example, we just had University of Michigan Consumer Confidence Survey coming out and showing an unexpected decline. What are you seeing in the business?
Yeah, we've seen all the same data that everybody else sees, but we haven't experienced it in our business. One of the things that I'm really proud of the team is we continue to improve our food and our service and our atmosphere, the fundamentals of casual dining. That with the industry-leading price point of $10.99 for a complete meal, we really think is winning with the customer. I was listening to an earnings call of a fellow CEO in fast food the other day, and he was talking about how his customers are coming up to their drive-through. They're seeing combo meals over $10, and it's making them think differently about that concept. And we've been able to slide in and fill that need. We're doing it with a superior offer, with great experience and a great food, and that's working right now with the guest.
So as I mentioned, this is a turnaround. You've seen these big double-digit gains. When are you going to start to lap those gains? And should investors then be expecting those like 20% plus gains to go down to the teens or single digits? Sort of what kind of cadence are we looking for?
Yeah, we provided a lot of detail on our earnings call about that because that is actually on everybody's minds what's going to happen when we have to comp the comp. We had a really great quarter this quarter. We were, plus 24. That was rolling a plus 15. So we're already starting into the season of comping some big numbers, and we're doing a really good job of that. And we talked about on the call in Q2, which is next quarter coming up, we're going to be rolling a plus 31. In Q3, the quarter after that, we're going to be doing another plus 31. And we talked about the plus 43 that we're going to have to roll in November. And we expressed confidence we're going to be able to comp the comp every quarter throughout the fiscal year. And that has been baked into our guidance. So there are so many good investments that have been baked into the business over the last 3 years. We're a much stronger concept than we were 3 years ago. And that makes us very confident in our ability to continue to improve food service and atmosphere and be able to comp that comp.
You guys have been spending a lot on marketing. The latest number was $137 million. As you pointed out on the call, you guys have been winning awards for your marketing as well. And obviously, you're not worried about sales, showing any slowness here. But I do wonder about diminishing returns from something like marketing, where when you get sort of fatigue around campaigns and the like.
Yeah, it's just the opposite right now because the experience is so much better. We're actually getting a better return on our marketing. So, like when I started about 9 months in, that's when we turned on marketing for the first time on the 1099 deal. We saw about a 3 to 5% lift in traffic when we would turn on advertising. A year later, we turned on the same offer and we saw much higher spikes. And I think it's because the experience was so much better that when people come in, they have the exact experience they see on TV, and it gets them to come back more often. So we're bringing a lot of new guests in, and they're frequenting Chili's as often as the existing guests, which tells us we're on the right track there. So I don't think it's going to be a function of anybody getting tired of marketing. It's really about how do we continue to put more dollars into the marketing till, because we continue to get a better and better return on investment.
And you guys are also putting more dollars not into expanding the number of stores, but in revamping the existing stores. I'm curious about the return on investment you're expecting from that upgrade cadence.
Well, the answer is we don't know yet. So we're going to do our first 4 reimages. We call them the modern Greenville image in Dallas here. We're going to learn a lot about that. And then in the back half of the year, starting in January, we hope to start ramping that up with the ultimate goal of getting to 10% reimages a year. We think the opportunity is a lot of our restaurants haven't been touched in 10, 20, 30 years. And so they need a little bit of love. And we have a really awesome design that the marketers have dreamt up of. We've got our design team, our construction team now figuring out how to bring that to life in a cost-affordable way. I think that could be another tailwind to our comp growth that we haven't had before. So continue to be very bullish about all the pillars of our strategy, food, service, and atmosphere. And I think atmosphere over the next few years are going to get a whole lot better with these reimages.
And Kevin, we've been talking all about Chili's. We've not been talking about Maggiano's, which is a much smaller part of the business and also not a performing part of the business. So what resources are you putting into that? And at what point do you say, well, maybe we want to sell it or do something else with it besides what we've been doing?
Yeah, we're excited about the Maggiano's brand. There's no reason why we shouldn't be able to turn it around like we've turned around Chili's. It's a lot of the same challenges that we had 3 years ago on Chili's, we still have on Maggiano's. And so we're going to be focused on food, service, and atmosphere. Food being Italian-American favorites that are served in abundant portions that create incredible value. And then from a service standpoint, it's all about making guests feel really special, almost like they're unchained. Like when we talk to guests, they talk about Maggiano's service when it's at its best. It feels like that local red sauce Italian joint. And so I think if we get back to that North Star and we get really honest about improving in those areas, I don't know why we wouldn't have a great turnaround there too.
I want to ask about some bigger macro trends, not so much about consumer spending, but a trend that we have noticed is people drinking less alcohol. You guys really leaned into cocktails. That's been a successful strategy for you. But I believe the latest Gallup survey showed, 54% of Americans drink now, which is the lowest that it has been ever. Are you seeing any kind of lower ticket as a result of people maybe coming in but not drinking?
Yeah, we've never actually been a huge bar concept. We're a bar and grill, and the grill, we're much more heavily leaned on the grill side. When we were at our best, there's about a lot of young families coming into Chili's. Maybe mom and dad would have a margarita or a beer, and then the kids would have something to eat. And that's really consistent where we are now. Our alcohol mix is only 10%. We actually held it flat, which we think is a win, because we're bringing a lot of innovation to create excitement for the guests to come in. So, we have our Shark Attack $6 margarita that's out right now. That's made with El Jimador and triple sec. So it's a very high quality margarita. That's $6. You're not going to get that anywhere else. The other thing that we just launched, which I'm super excited about and is doing really, really well, is our new Frozen Patron program. We basically upgraded our frozen program to something very premium, and the guest is loving it. So even though it's a considerably higher price point than our old frozen base, the reality is we're selling almost 2x of what we were selling before because the product's so good. So we've been able to hold alcohol flat. We're bringing news to alcohol to just create excitement for the total box, and we feel pretty good about it, but we also are not overly dependent on alcohol, which is a little bit different than some other concepts.
Do you guys sell any non-alcoholic offerings, beers, for example?
No, we do. We have a little bit of that, but we're primarily focused on, we're a margarita bar, and a lot of people don't know. We sell the most margaritas in the world. We are the margarita experts, and now we've really blown out our portfolio. So we have $6 margaritas like I just showed you. We go all the way up to about $15 with a Casamigos or a Don Julio. And then we've got everything in between. I call them margaritas with benefits, like a skinny margarita or a frozen margarita, at a mid-tier price point. So the reality is we'll continue to extend our lead as the #1 margarita and tequila seller in the world. And I couldn't be more excited about it. That's truly true to our brand.
And then the other question I have for you, sort of on a macro basis, is the effect of GLP-1s and new weight loss drugs on the market, where we have seen in some sectors sort of a change in consumption trends. You know, you guys are known for the margaritas, as you mentioned. You're also known for pretty big portions. And so I'm wondering if you've seen any kind of changes on that front.
Well, the cool thing is Chili's is for everybody. We're one of the only retail outlets that actually, when you look at the microcosm of all the demographics that frequent us, we look exactly like a snapshot of America. So we've got all kinds of people coming in. We've got people that want extreme value and they want abundance. We've also got people that want something a little bit lighter. We've had our Guiltless Grill menu out there for decades. We continue to innovate on it. You know, some of our most favorite dishes come from that, like the margarita grilled chicken, and we just launched a skinny margarita for those that want an alcoholic drink, but it's a little bit lighter. You know, the GLP-1s aren't going to be they're not the first diet drug to come out there. They're not going to be the last one. And Chili's is going to continue to adapt to people's needs and make sure that we have something for everybody. So we're not particularly worried about it. We're going to watch it just like any other potential risk to the business. But right now we feel like we're positioned well.
Kevin, thanks a lot for joining us. We appreciate it.
Hey, thanks for having me.
Take care.
Have a great weekend.
You too. Coming up, how could adding private markets and crypto to your 401k affect your portfolio? I'll speak with a financial advisor about just that next on Market Catalysts. An executive order signed by President Trump last week would allow 401k plans to offer alternative assets, including private equity, real estate, crypto, and infrastructure. What would that look like in a retirement account, and what are the benefits and risks? Let's bring in Lawrence Sprung, Midland Financial founder and author of Financial Planning Made Personal, for this week's FA Corner, brought to you by Capital Group. Lawrence, it's good to see you.
Good to see you.
So this would be a big change in 401ks to have these assets in them. What is important to keep in mind if investors are considering whether they should put these in their 401ks?
I think the most important things for them to consider are: how old are they? What's their risk profile? What's their time horizon? And do these instruments add value to their overall allocation or add too much risk? And then make the decision how they're going to allocate those funds to those areas.
Okay, so let's talk about, let's take private equity as an example here. What are some of the pros and cons of something like that?
So I think it's going to be a huge win for the product manufacturers, because now they have this whole new opportunity of client base, right? Mm-hmm. So it's going to be a huge win for them. As far as clients go, they have to be concerned and look at, well, is this really adding alpha, increased returns to my portfolio? Am I okay with the potential illiquidity, because I may not be able to buy and sell these as actively as my other investments in my 401k? And what are the costs? And do those costs offset the benefits that I'm getting? So there are things to look at, overall, that I think are a little bit more difficult than just looking at traditional stocks and bonds.
And we should mention as well, this, even though the executive order was just signed, it's not happening immediately, right?
Correct, yeah. It's going to probably be months before the Department of Labor starts enacting this. And, there is some, uncertainty whether it actually goes through. I'm pretty certain it will ultimately end up going through. It's not a matter of if, it'll just be a matter of when and how long that is.
And Lawrence, I'm curious whether, your investors, people that you're advising are probably already in some of these instruments, right? Has there been a big increase in interest in things like crypto from your clients, things like private assets?
We are definitely getting more inquiries over the last, let's say, 2 years than we ever had in the last 15, right? And I think it's primarily because everybody's hearing about it. Everybody's hearing about the boon in some of those areas. So there are additional questions, and then it's a matter of working with them to have them understand what the pros and cons are, and if it makes sense for them in their own individual situations.
And are there things that people need to think about holding an asset, whatever it is, be it equities or anything else, outside of a 401k versus inside of a 401k?
Sure, there are inherent benefits to both, depending on what your goals are with this money, right? The benefit to having it in the 401k, if you have it in the traditional side, is that money's going in, it's growing tax deferred. You'll pay taxes when you withdraw it. If you're doing it in the Roth 401k component, then you're going to have a tax-free growth of that asset in perpetuity, and you won't have to pay any taxes. Whereas outside the 401k, in your individual name, it's going to be either a long or a short-term capital gain at some point. There are, benefits to holding things long term in terms of not paying as much in taxes as short term, but you will have to pay taxes. So if there are assets that are more risky that you may not need long term, you may benefit from putting it in the traditional or that Roth 401k component because you'll receive some significant tax benefits.
Now, switching gears, there's something else I wanted to ask you about, because during the commercial break, you told me you're getting a lot of questions about it. And this is something else that's a policy change from this administration, and it's the so-called Trump child accounts, right? The seeding of a bank account with $1,000 when a child is born. What's going on with those? Are they happening?
So it was passed in the One Big Beautiful Bill, and as of January 1, you are able to start doing those and
January
having
1 of this
2025. It was able to be seeded, but the issue is none of the custodians, none of the investment firms at this point that I'm aware of were prepared for it or are prepared for it. So what I'm hearing is sometime in 2026, hopefully early 2026, these accounts will be available and people will get them seeded back to January 1, 2025, and then they'll be able to start contributing. But we've gotten calls about it. People are anxious to set them up and get them going, but nobody's really prepared to get these moving in the right direction at this point.
And just real quick, if you're putting in $1,000 when your kid is born, you want to be pretty aggressive with the investments initially, I would imagine.
I would. I mean, you have at least an 18-year runway. Chances are that there's a lot of runway there that you can withstand that volatility and benefit from that compound growth over that period of time.
Right. Lawrence, good to see you. Thanks for coming in. We
Thank you.
appreciate it. Thank you to Lawrence Sprung for joining today's FA Corner, brought to you by Capital Group. Well, coming up, we got full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst. First up, Fed watchers turn to Jackson for clues on the central bank's rate path. We'll break down what to expect and speak with a potential nominee to replace Powell at the Federal Reserve. Plus, the latest consumer sentiment data signaling some caution despite a pickup in retail sales. We'll have full coverage ahead. Plus, Congresswoman Lee Stefanik calls on Attorney General Pam Bondi to investigate Standard Chartered Bank. We'll bring you the details on why and much more on Market Catalysts. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here as we take a look at the major averages. We've got a mixed picture here. The Dow still hanging on to gains, although off its highs of the session. The S&P 500 down 0.25%. The Nasdaq down about 0.4%. And the S&P 500, recall, closed at a record yesterday, so coming down from those levels. Well, all eyes are on the Federal Reserve as it considers an interest rate cut and also as the central bank prepares to undergo a change at the top next year. I'm joined now by Mark Summerlin, Even Flow Macro founder and managing partner, and Yahoo Finance Fed correspondent Jennifer Schonberger. Mark Summerlin, one of the folks who is on the longer list of potential replacements for Jay Powell at the top of the Federal Reserve. So, Mark, thank you so much for joining us. You have confirmed that you have you've been in touch with the White House, but you have said in interviews that you have not met President Trump. What is your sense of how this process is being enacted, how they're choosing candidates, and kind of where they are in this process?
Great. Well, first of all, thank you very much for having me. My understanding is they created a list of 11 people. These will all be vetted and interviewed by the Treasury Secretary, and at some point that list will be narrowed down to a smaller subset, and that subset will then go on for President Trump to pick. So that's about all that I know at this point in time, and so we're still weeks and months left, I think, before we get a final decision.
Back in 2018, there was some reporting that you had been nominated as a Federal Reserve governor, and that you said that you didn't want that job at that point. Can you tell, is that indeed the case? And do you want this job if indeed you do end up getting nominated?
Yeah, no, that was a little bit of a complicated story, but they had asked me to serve as a governor, which I said yes to. And I had my interview with Secretary Mnuchin, And the plan was then to go to meet with President Trump in the Oval Office. But before that happened, President Trump nominated two other people for those positions, Herman Cain and Stephen Moore. And I'm not sure what the process was for that. And then 6 months, they ended up not getting confirmed. And then 6 months later, they came back to me. And at that point, I'd sort of moved on to other things. And so it was just a different
Gotcha.
set of circumstances.
Fair enough.
then.
If you got this nomination, would you take it?
I think, Fed chair is mission critical to the world. And I think
enough.
if you believe you're up to it, you got to do it.
Jen, I want to bring you into this because I want to get to current Fed policy. Aside from the choice of who's going to be leading up the Fed, I want to get to current Fed policy and the outlook. Next up, as we've been talking about, we have the meeting in Jackson Hole, then the September meeting. We got a lot of data between now and then. So what are we watching most closely?
Most closely watching for that tug and pull between both sides of the Fed's dual mandate. This week, we got news on the inflation front. The producer price index and the consumer price index showed that services inflation heated up a bit in the month of July. The Fed has been closely watching for the impact of tariffs on inflation. So the fact that we saw the services side, which accounts for a larger swath of our economy, start to bubble up has caught their attention. Chicago Fed President Austin Goolsbee said earlier this week that if we were to see subsequent reports where services inflation was on the rise, that would cause concern. And on the other side of the dual mandate, we did have that weaker than expected jobs report for the month of July. And so that has caused some members of the Fed to look at that side of their dual mandate and look towards a cut for the September policy meeting. I will be closely watching Fed Chair Jay Powell's speech next Friday in Jackson Hole to see whether he lays the groundwork for a rate cut at the September policy meeting. And it may very well be the case that the next jobs report for the month of August, due out on September 5th, will be the determining factor.
Well, it seems like in order to be considered for next Fed chair, the base has to be that you think that the Fed should be cutting rates now. You happen to think that, Mark, is my understanding. What, in your view, what is the data that does support the case for cutting?
Right. I mean, so if we look at the first half of the year, the economy was growing a little bit over 1%. And, it's not surprising because we had some fiscal contraction coming from the tariffs, and a 4.33% Fed funds rate is just too high. And the market will always tell you what you should be doing or give you pretty good clues. And the inversion in the front end of the curve, meaning that the 2-year bond is sitting about 60 basis points below the Fed funds rate, tells us that we can probably cut by 50 basis points without making the long end go up. And we had when we got the data revised, we discovered that there was almost no job growth in May and June. And had we got those numbers in real time, the Fed probably would have cut in both June and July. And it's important to market to that data. And so up until that revision, we had strong jobs data, weak GDP. We didn't know which one was true. And then the jobs data got revised into that. On inflation, I support an inflation range of that. I think anywhere between 1% and 3% is on target, because we can't really measure inflation with any precision. And we can't really control it with any precision. And so I'm less worried about inflation really accelerating, especially when we have demand growth a little bit on the weaker side right now.
Mark, it's Jennifer here. Curious, to your point, if you do think that the Fed needs to play catch up here and cut by 50 basis points, how do you see the rate path for the rest of the year? Are you concerned that we are going to see some major weakening in the economy in the second half of the year, given what you just said about the job market and the prospect of weaker demand?
Yeah, I think right now the economy is probably growing about 1.5%, so still below normal. So I don't have anything like super weak, but just weaker. And that'll change next year. We're getting tax stimulus coming in, in March and April. And so what I would do is I would cut 50 basis points, and then we would get new data. We would see how the long end of the curve reacted to that. And then we would decide whether we needed a few more cuts or not after that.
Mark, something else I wanted to ask you about is something that you wrote in a recent op-ed in the Wall Street Journal, something that is much more sort of a traditionally Republican view. And we should mention you served as an economic advisor in the George W. Bush administration. You wrote, the next Fed chairman will need to call on Congress to reduce the federal deficit from 6% of gross domestic product to a more sustainable 3%, preferably by relying on spending reductions more than tax increases. And I guess I would ask a couple of things here. Firstly, traditionally, this has not been the purview of a Fed chair to comment on these kinds of matters. So I wonder if you got the job, would you then lean into that? And secondly, I wonder, this is not a view that the president seems to hold. He has not prioritized those deficit cuts and certainly not spending cuts of the type that were talked about maybe early in the administration. So I'm curious what you think on that front.
Yeah, my view is that fiscal and monetary policy, the first choice is to have them be working together. The Fed always has to be independent in case the administration has different goals at the time. But the first choice is for them to work together. And so absolutely, I would, as Fed chairman, I would call on Congress to reduce the budget deficit. The budget deficit is high enough right now that growth will accelerate if you reduce the size of the deficits. That would bring down long-term interest rates. And we just can look and see that housing is the weakest part of the economy right now. And with mortgage rates up towards 7%, the housing market is just not running the way it should. And so we're in a kind of a win-win situation where if we bring down the deficit, we're going to bring down long-term rates and we're going to accelerate the housing market. And so I think the Fed chairman can't tell Congress specifically how to do it. I do definitely have my own views. I started off, my first job was on the Senate Budget Committee. So I know a lot about the budget as well. But I would certainly be advocating for more deficit reduction as Fed chair.
Mark, Jennifer here again. Treasury Secretary Scott Bessent, who is leading the interview process for the next Federal Reserve chairman, has said that he's also looking for how that person could revamp the central bank. So I'm curious, what changes would you make to the Fed? And have you spoken with Treasury Secretary Bessent?
Yeah, I mean, first of all, I've known Secretary Bessent for over a dozen years. So we've been talking about monetary policy for a long time. I would, for two changes, one super simple. Fed staff should not be making political donations, in my view. We can see they're overwhelmingly to one party. That reduces the Fed's credibility. And so I would make that change. The second big thing I would do is I think the Fed staff is not oriented properly towards what the Fed chair needs. And the way I think about the job is there's sort of three categories you need to master. One is the economic data and the models. That's going to be part of it. The second is really understanding financial markets and what they're telling you. Everything from the shape of the yield curve to credit spreads to energy prices to currency movements. And then the third part is really understanding what's going on in corporate America. Especially at a time right now when AI changes are accelerating and really being in touch with that. And the Fed staff is oriented only towards that one kind of inward looking economic models and data. And so I don't have a problem with having several hundred people because the job is so critical. I would just want to have an expert in every sector of the economy. I'd want to have someone that understands credit spreads and really have just a more expansive view. In a way, it's a little bit more back to the ways like an Alan Greenspan did things.
Mark, thank you so much for joining us. We appreciate it, and we'll keep in touch as the process goes on. And as always, thanks to Jen as well.
Thank you so much.
Coming up, the history of Intel. We're taking a look back at the company's rise and fall. That's next on Market Catalysts. Intel shares are rising on reports that the Trump administration is in talks to take a stake in the company. This comes as Intel has been struggling to compete with the changing tech landscape, facing increasing competition from tech giants like NVIDIA. Joining me now, Yahoo Finance tech editor Dan Halley. And Dan, given everything that's been going on with Intel this week, we wanted to sort of take a step back, look at Intel's history, and figure out what went wrong, right? So what are some of Intel's sort of biggest failures over the past decade or even decades?
Yeah, unfortunately, there's a good number of them, Julie. And let's just take it from basically the most important, and that's its inability to capture the mobile market. There was a time where Intel had the opportunity to go ahead and start investing in smartphone chips. It just completely missed the boat on that. And at one point, it had the opportunity to be the chip maker for Apple for the iPhone. Decided not to go with that. Apple went with ARM, and kind of that's the rest is history. They did try to get into smartphones, by the way, at one point, but they just couldn't figure out how to get it going. The power and battery life wasn't good. It just never really seemed to take off. So they missed out on that. They also missed out on just going into GPUs and AI. They've had opportunities over the years to go into this. They have built in graphics processing in their own chips, but dedicated graphics cards themselves, they never really got into. They tried to more recently under Pat Gelsinger. They still have some, but it's going to take a long time for them to catch up to NVIDIA and AMD. And then obviously just not being able to advance their chip technology along with the likes of TSMC, which really is kind of the leader now when it comes to that chip making process. So they've just missed out on these three big kind of key areas and smaller ones, sure, but really, it started with missing out on mobile and then just going into those GPUs, and then the process technology just isn't there. They're trying to reach it, but it's just not there yet.
So Dan, I was taking a look at the charts, the various charts for Intel, stock charts, revenue, net income, and all of it kind of peaked and then started to roll over. Only in the last, 4 to 5 years, really, we have seen that happen.
Yeah, I mean, look, during the pandemic, it was a boon for them, right? But that was a one-time thing. I hope that that's a one-time thing. But the idea is that, people went out, bought computers because they didn't have computers at home. Maybe they used them at work, or maybe they had them from school, or maybe they needed another one in the house because everybody was stuck at home. So they just went out and bought a bunch of PCs. And so that helped Intel momentarily. It also messed them up going forward because of all the pull forward in revenue that they had seen. But other companies had to deal with that too, and they've straightened it out since then. Intel just hasn't been able to get back to a level to where people are saying, okay, I need a new computer right now. I need to go out and get one. And look, people's main kind of computing device now is their smartphone. They don't spend too much time on their laptops unless, maybe they're in school or they're in the office at home. You're not sitting on the couch with your laptop, you're sitting on the couch with your smartphone. And so, if people are going to upgrade something first, it's going to be their phone, not their laptop. They're hoping to see a lot more sales with the end life of Windows 10, Microsoft's Windows 10 in October. We're just not seeing, the kind of growth that we saw in 2020.
And when I was looking at the stock chart, first of all, I realized that this was one of the tech names that did not reattain a record high during the pandemic. Its record high still stands as being back in the year 2000. So that's interesting. But its more recent peak was indeed during the pandemic. But all of this now brings us to today, right? And what we are seeing, the pressure from the White House initially on the newish CEO, Lip-Bu, and then reportedly a potential stake in the company.
Yeah, I mean, look, Lip-Bu kind of came in with this kind of almost losing proposition, right? Where, Pat Gelsinger tried to turn the company around, turn it into a contract fab. Basically, they would make chips for other folks, right? Similar to what TSMC does. But that requires a ton of money. And so they've just been burning through cash to get there. Now they went and said they were going to build out that big Ohio plant. They were going to build plants in other countries. Lip-Bu comes in, says, yikes, let's not do that. Let's cut back. Let's delay the Ohio facility a little bit longer. Let's cut some of the plants overseas. And now he's kind of trying to turn this ship around. But the problem is, they have their 18A process, which, there's been reports that companies aren't satisfied with the yields from that. Intel does say that they have contracts from Amazon and Microsoft to build their next generation AI chips, but they're going to start moving to 14A. These are hundreds of millions of dollars on these different processes, and so it's tough to see how they pull out of this in the near term. In the long term, they may, but it's going to take a lot of changes for Intel to really kind of regain its stature, if ever.
And maybe it will come with assistance from the U.S. government. We shall see. Intel did respond in a statement to the possibility of the U.S. Investing in the company, potentially even as reported using CHIPS Act funding to do so. Intel says Intel is deeply committed to supporting President Trump's efforts to strengthen U.S. technology and manufacturing leadership. We look forward to continuing our work with the Trump administration to advance these shared priorities, but we are not going to comment on rumors or speculation. So keep your eyes on this space, I suppose, Dan, when it comes to what comes next in that relationship.
Yeah, I mean, I think that this is all going to, we'll see something eventually. President Trump doesn't have the kindest or fondest feelings for the CHIPS Act. So, I mean, he could use that money. We'll see. But I think, there's been different permutations of these ideas of the U.S. getting involved, whether that's TSMC taking a stake in Intel's foundry or Intel maybe getting rid of the foundry entirely for third parties. So, I mean, there's been different ideas floated around over the past couple of years as to how to do this for Intel. One thing has to happen, though. That they need to start turning this around. And look, like I said, Lip-Bu's doing that with regards to the plants. He's also unfortunately had to lay off workers and make some other concessions. So we just have to see if any of this really works for them.
And we shall, Dan. We'll keep on top of it. Thank you so much. Appreciate it. Coming up, we got much more markets action, including a check on where we're trading from the NASDAQ. Stay tuned. You're watching Market Catalysts. Sentiment fell for the first time since April last month as inflation expectations climbed. Anxiety around the impact of tariffs is weighing on the minds of consumers, but is inflation being driven by more than just tariffs? Yahoo Finance's Allie Canal live at the NASDAQ with more. Hi, Allie.
Hi, Julie. And that's a question that's hard to say. Heading into this week, the focus was on core goods and the potential tariff impact on everything from apparel to furniture. But instead of a sharp jump in goods, we saw services inflation firm. That showed up in both the CPI and PPI reports earlier this week. The producer price index that surged to a 3-year high, signaling that businesses are absorbing much of the tariff burden. So the concern now is those higher costs could soon be passed on to consumers, making the services side of the economy more expensive, just as the full tariff impact on goods is still set to play out. Now, markets may be mostly shrugging this off, still trading at those record highs, but economists are warning that the tariff effects haven't fully landed. Raymond James chief economist Eugenio Elliman, he said in a note this week, quote, "The full impact of tariffs is expected to materialize in next month's data, potentially pushing good prices higher. This complicates the Fed's September decision." And complicate is the key word here, Julie, especially after this morning's stable retail sales report. So this is really the chatter on Wall Street right now. And here's a bit more of what economists told us this week.
I'm more concerned about its impact on future CPI prints. I think it's telling you that the price effects are starting to work its way throughout the supply chain. Yeah, maybe the July CPI print wasn't that strong, but come August, September, we might start to see firmer prints, and that puts the Fed in a tough spot.
The good news here, as you say, is that tariff impulse into inflation wasn't as high as anticipated this month. The bad news, as you pointed out, is that services inflation was pretty soft in prior months, and it did give the impression to many that, hey, maybe we could ignore tariff inflation because services weakness will offset it. But now I think a lot of that's reversed.
These are broad-based inflationary pressures that we're seeing just now. I see more reason for rates to be rising in order to not let inflation get away from us. Inflation is the risk that's on our doorstep, much more so than the labor market. The Fed officials know that.
And we do know that markets are still pricing in with near 100% certainty that the Fed cuts interest rates in September. Of course, Jackson Hole next week is going to give us a lot of clues into the thinking of the Fed, with Federal Reserve Chair Jerome Powell set to speak. But even with that September rate cut priced in by markets, investors still think we are going to see an additional 1 to 2 rate cuts from there to really end 2025 with about 3 cuts in total, and then more rate cuts are expected in 2026. So we're seeing that play out a bit in the bond market. Long-term yields, like the 30-year yield, for example, is ticking higher today. But all of this a big question mark as we continue to wade through this data, with more prints and reports expected in the weeks and months ahead. Julie.
Now time for some of today's trending tickers. We are watching Standard Chartered Bank, Joby Aviation, and Target. First up, Standard Chartered, the British multinational bank, falling today. Congresswoman Elise Stefanik says she has asked Attorney General Pam Bondi to investigate the bank for, quote, illicit payments to known terrorists. Stefanik is also accusing New York Attorney General Letitia James of inaction on the payments while approving its bank license. The U.S. representative alleges the bank made at least $9.6 billion in illicit payments. She also alleges that the Attorney General was briefed by terrorist finance experts and whistleblowers about these payments. Stefanik calling on Bondi to prevent an ongoing sanctions evasion case against the lender from expiring. Standard Chartered telling Bloomberg these allegations are false. Next up, Joby Aviation announcing it successfully completed its first piloted flight between 2 airports. Shares initially rose on the announcement. They've since pared those gains. The flight operated in FAA-controlled airspace between California airports Marina and Monterey. The company noting this is critical for its path to commercialization, as the flights demonstrated the real-world service that Joby intends to offer to the public. And finally, Target was cut to underperform at Bank of America. The downgrade coming as analysts cite a deteriorating long-term outlook for the retailer. Bank of America also sees increasing competitive threats from the likes of Walmart and Amazon. The bank cut its price target to $93 from $105. You can see the shares trading just under 103. It's also important to note Target shares took a hit just yesterday after they, said they were going to end their partnership with Ulta next year. That deal had seen 600 Ulta store-in-stores added to Target's. That helped increase foot traffic. Also, keep an eye out for those Target earnings. They are due next Wednesday before the start of trading. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending ticker page. Cryptocurrencies, they've been on a tear, benefiting from policies out of the Trump administration and more mainstream adoption. Soon, Americans could even find crypto in their 401ks. But 48% of Investopedia readers say crypto might be overvalued, the asset ranking just below AI stocks in a new sentiment survey. Market Domination host Josh Lipton sat down with Caleb Silver, Investopedia editor-in-chief, about the sentiment around crypto.
Still skeptical. That said, more readers than ever own it than used to. We have about 27% of our survey respondents saying they now own cryptocurrency. Most of that is in Bitcoin, and it seems kind of irresistible when you look at the price trends. I just did a thing looking at the 10-year track record. It's up 44,400%.
Not bad.
How are you doing? Are you not entertained? But the streets are paved with crypto in Washington, D.C. This is what the administration wants, even though Treasury Secretary Besson's saying they don't intend to buy Bitcoin for the strategic reserve. They
By the way, on that Besson headline, in your opinion, big deal, no deal? Were you surprised by that?
I was happy by that.
Yeah.
I really don't want our Treasury buying Bitcoin out on the open market. That said, he did say that the U.S. has some $19 to $20 billion worth of Bitcoin from all those asset seizures. So we don't necessarily want that in as a growing part of our reserves, especially if we're going to be dollar denominated going forward. And I think when you think about who owns Bitcoin, most of the Bitcoin is owned by about 50 whales out there, and having the U.S. insert itself into that conversation in a bigger way, probably not a great strategic policy move. That said, we are going to see Bitcoin in our 401ks. You can already buy it tangentially through the spot Bitcoin ETFs or by investing in a micro strategy.
Is that a good thing? More options, more choices for people?
In a way, you get more diversification in your portfolio and the potential for more upside. You also get some potential hand grenades in there that could blow up, and you have to have a very strong stomach for investing in Bitcoin, especially for the long term, and be ready to deal with the dips. But if you've had it in there, even as a 5% allocation in your portfolio over the last 5 years, it's it's helped quite a bit, even though it's put you through some nauseating moments. And the fact that we're also going to get private equity in there, also another risky asset by definition with less transparency. This is a time more than ever that investors, long-term and retirement investors, need education, because a lot of people still don't understand these asset classes and what they can do inside a portfolio.
The recent move higher in Bitcoin, what would you chalk that up to, Caleb? Would you say that's the regulatory backdrop getting friendlier? Is it institutional demand? What is it?
Yeah, all of the above. And the fact that institutions really haven't totally embraced it yet, outside of the BlackRocks of the world that have some $75 billion worth of Bitcoin. Fidelity, we know, has been deep into Bitcoin for a very long time. But you're going to start to see the traditional asset managers start to offer it more, start to offer more options in investing in cryptocurrency, particularly Bitcoin. There's that. There's the fact that if you're looking at the regulatory highway, all you see is green lights from this administration. They want to be in it, they're in it themselves, and we know that's going to be a broader part of the capital market. So people need to understand that this is where it's going to go, whether or not it's backed by anything or what happens if you lose your crypto. All those questions about the security of crypto and Bitcoin itself still remain in question, which is why more than half the country still is very skeptical about it if you look at the recent
And you own
Gallup polls.
Bitcoin.
Of course.
To be clear.
I've been buying it, and I've been buying it for years. I wish I would have bought more of it for years like a lot of other people, but I want to understand the asset class. I want to understand the way it works. I want to understand how it actually fits into my portfolio and what happens when we get a big surge like the one we did. How does that change my risk profile when I'm looking at my retirement portfolio?
One question for you. In terms of the role Bitcoin plays in a portfolio, Mike Novogratz puts it like this. He says, it's digital gold. I've heard Novogratz say that it's digital gold. Don't overthink it. It is simply, Novogratz argues, it's a hedge against irresponsible fiscal policy the world over. Is that how you see it?
That's one of the ways that I see it. I also see it as a potential upside trampoline when they need better performance. Sometimes it's coming out of cryptocurrency, but it is a small percentage of my portfolio. I've made a rule to never make it over a certain amount in terms of percentage, in terms of its weight in my portfolio, because I have other things that I need to worry about here, and it's still being developed. It's still mysterious, but it is one of those scarce assets. It is the OG of cryptocurrencies. It's not like it just got here. It's just going to get a much more hospitable environment in this country to be a part of our capital markets one way or the other.
Stocks are on a tear once again. The S&P 500 just notched its 17th record closing high of 2025, and it seemed like a good time to answer a very basic question in today's Stocks in Translation: which is a better investment strategy, buying the rip or buying the dip? First of all, I started off by creating a chart here. I went all the way back to 1960 to get over 60 years of market history in the S&P 500, and I ran a study to see what the stats were if you were to buy every single all-time high in the S&P 500, all 1,100 of them, and then I compared that to buying every new one-year low or 52-week low, all 500 of them. Then finally, to have a baseline, I measured the results of buying every single day, all 16,000 of them plus, and guess what? For returns or performance, first of all, this is what we're showing in this chart. It is the median, which is very similar to an average, but you don't have it as exposed to outliers as much. So first of all, what if you were to buy every new high and hold for 1 week, 1 month, 1 quarter, 6 months, 1 year? That's what we're seeing in white. And so for some of the lower time frames, there's really not a lot of juice to be gained out of those. You can actually see that buying new lows was a slightly better strategy for 1 month out, but when you get to 1 quarter here and 6 months out, it's not a very good strategy at all. In fact, you want to be buying the highs if you're just an intermediate term holder there. Once you get to 1 year, the results improve dramatically. Just in terms of median returns, we're looking at about 10% plus, and you can see actually that buying new lows produces slightly better results. Now, the actual returns and what we're looking at here in median returns is not the only metric you want to consider. You also want to consider the hit rate, the win rate, or percent positive. And that's what I'm presenting here. So this scale goes from 40 to 80%. Nothing even approaches 100% or goes below below 40. So at 1 week, 1 month, we're seeing pretty break-even results there, or neck and neck results, I should say. Then at 1 quarter and 6 months, these are the two time frames where buying the new lows, buying the dips wasn't the greatest strategy. Those have pretty bad percent positive statistics there. But then once again, once you get to the 1 year mark, you have pretty similar results between buying the new highs and buying the new lows. And compared to the baseline, there's not much of a difference between them. So I decided to go back to the drawing board, and I actually extended the study to include not only 1 year, but 2 years and 3 years out. So this is looking at the median returns again. How much are you going to see in your account? Now, 1 year, we already saw those results, but I left them in there so you can compare to what happens to 2 and 3 years. What's interesting is that buying new lows is a much better strategy in terms of returns once you go 2 years out and also 3 years out. Although buying the highs kind of comes a little bit closer to those buying the new lows once you go 3 years out. And it's neck and neck with that benchmark, which is buying every single day. Now, if we take a look at percent positive, we can see the results don't vary that much over the long term. So for 1 year, we're looking at percent positive of about 70, 75% here. 2 years out, everything's neck and neck. That approaches 80. And then at 3 years out, we're a bit above 80%. What I didn't show here was the volatility. And if you take a look at the volatility that we experience in some of these studies over the short term, let's say 1 week up to 1 year, you have a lot more volatility if you're buying the dips. And that's not surprising. Bull markets are boring. And so when you're buying the highs, you're not experiencing a lot of volatility on those results. But when you're buying the lows, it's easier to get shaken out. So if you don't have a stomach for all that volatility, you might not want to be buying all those lows. But to conclude, I found some interesting things in here. Buying the dip tends to deliver the best returns overall. And then if you go up to 2 years out, buying new highs, that wins more. That's that percent positive that we were talking about. And then in the short term, buying the dip can be a bit bumpy, and that speaks as to the volatility I was just speaking about. And finally, the best strategy for holding long term, that's 3 years and out, buying the dip is the best.
While July retail sales marked a second consecutive month of gains, rising 0.5% in July, the latest consumer sentiment data declined as Americans expect tariffs to fuel rising prices. With earnings from big box retailers out next week, we want to take a twofold look at all things retail, how consumers are spending against this macro backdrop, and then how companies themselves are faring and handling all of this as well. Here to discuss, we've got David Silverman, Fitch Ratings Senior Director, as well as David Tinsley, Bank of America Institute Senior Economist. Gentlemen, Davids, shall I say, thank you both for joining me. David Tinsley, I want to start with you just on your general reaction to the retail sales data that we got today, which sort of was generally in line with expectations, but it was interesting to look under the hood at where we saw increases and decreases.
Yeah, generally in line with expectations. Quite a decent backward revision. When we look at our own data, our own credit and debit card data, it kind of chimes with that picture, really. Strength in July, strength in June, reversing weakness seen a little bit earlier in the second quarter. And when you dig into the broader consumer picture, services, very strong actually in July. Not so much restaurants, as you saw in the retail sales print, but in our own data, an uptick in airline spending and in lodging spending, which is quite encouraging for the overall picture going forward, I think.
And what about you, David Silverman? Any kind of surprises in here, or, because we've been hearing from companies during earnings season, was it pretty clear what we were going to get here?
Sure. We downgraded our outlook on U.S. retail earlier this year to deteriorating, given concerns that we saw regarding consumer health, exacerbated by what we saw the impact from tariffs could look like as we've gone through the year. As David mentioned, since that time, results have held up relatively well. What's difficult to know and what we're looking at closely is some of the key discretionary categories like furniture, consumer electronics, and apparel, where consumers could be pulling purchases forward during the current periods in advance of what they may perceive to be a period of rising prices going forward. There was a bit of a mixed bag in July. Some of these categories continue to hold up quite well, and some we're starting to see potentially a bit of dislocation. That being said, we are still expecting to see moderation in consumer goods spending, particularly in discretionary categories as the year progresses.
Well, I'm curious, David Tinsley, you mentioned your bank's credit card data, which is a great source of what people are doing sort of in real time. What about its predictive ability, right? Are there any signs telling you whether, to David Silverman's point, kind of whether it is going to keep up going into the fall?
Well, I'd point to two things in our latest report, and in a sense they're cross-cutting. One is we see weakness at the lower income consumer end. So in our data, there's virtually zero growth year on year in consumer spending for the bottom third of households by income. But the good news, I think, is that middle and higher income households are continuing to spend. So I think, that does bode reasonably well in terms of going forward. And then the other thing I just mentioned is that when you look at some of the metrics of financial health for the consumer, like their ability essentially to spend on their credit cards, whether they're paying off their full balance every month, these look pretty good, better than they did in 2019. So I think, there's some clouds out there if you like, but by and large, the picture is still relatively sunny.
David Silverman, what about, though, in particular, that low-income consumer? Who are the retailers who are sort of most exposed to that consumer? And can we expect that they are going to see some struggles?
Yes, those retailers would be discounters and dollar stores are some of the primary examples. What's become interesting over the last couple of cycles is a lot of these retailers will both benefit and be negatively impacted by some of this dislocation in the low-end consumer. We could see trade down that benefits companies like Walmart and Target and Costco and Amazon. That being said, a lot of these companies over the last number of years have added discretionary products to their mix. And there's some risk that the low-end consumer pulls back on purchase of these types of items. So we could see some positives and some negatives that a bit offset each other as the low-end consumer struggles a bit in the current environment.
David Tinsley, are you seeing any kind of uptick in the data in credit card defaults or people taking longer to pay off their bills, for example?
Well, when you look at the New York Fed data on defaults, I don't think you've seen, they certainly did rise for a while, but they've sort of flattened off of late. And then when you look at our own data, as I was saying earlier on things like whether or not people pay off their balance every month, their full balance, the share of people doing that is up. And when you look at credit card balances relative to wages, you've got to remember you've had a good period of wage growth. It might have petered out a bit now, but the previous few years were very good. So relative to wages, credit card balances are actually fairly measured. So I think, the financial health of the consumer is pretty sound, I think, by and large.
And then, David Silverman, you talked about some of the companies and the various effects on them from trade down, et cetera. What about the companies that you think will do better? Are they the ones that are catering also to the higher income consumers?
Yes. In general, when we take a look at retail, we recognize it's a highly competitive industry with a lot of companies selling the exact same product or very similar products. So some of the key factors for success that we look at are retailers that truly understand their relationship with customers, their point of differentiation, retailers that have built out a strong omni-channel model that makes sense in the context of that relationship with customers, and retailers that have productive relationships with counterparties, particularly vendors. Underpinning all that is the advantage of strong scale and cash flow. So given all of that, the names that we think will continue to be quite successful in the short and longer term are those that can pull all of those factors together. They tend to be the largest companies already in the space, whether it's a Walmart, a Costco, an Amazon, a Home Depot, even a Macy's in a difficult department store environment.
We have talked curiously little about tariffs as part of this whole discussion. But, folks in the retail industry seem to be indicating, at least anecdotally, folks I've talked to, that we might see a wave of price increases more weighted towards the latter part of the year because of the way the ordering cycle works for holiday, et cetera. David Silverman, what do you think are the indications there? And what is that going to mean both for margins, but also for demand if prices go up?
Yes, so we expect to start seeing a lot of the price increases that you're referring to in that back to school season as inventory that's on the shelf becomes that inventory that's impacted by tariffs. We're seeing a number of different mitigation strategies. Retailers that are adjusting their supply chains. Retailers that can adjust the actual product in apparel. Remove a button, remove a zipper to mitigate the price, and retailers are then making their own individual decisions about how they choose to either absorb or pass on prices. Back to the last discussion, the companies that are larger with greater scale, with greater cash flow, have the ability to absorb more of those prices. What will happen over the course of the coming months, again, these companies all sell pretty much the same products, and consumers are able to price compare pretty easily. So we'll start to see as some companies like a Walmart, like an Amazon, start putting products on shelves, changing prices or not changing prices. Other retailers will have to follow.
Price wars, maybe. We'll see. David, thank you so much. Have a great weekend, guys.
Thank you.
That's it for Market Catalyst. I'm Julie Hyman. You also have a great weekend.